Is it time to buy the dip as lithium stocks tank? Well, we don't buy dips. That's speculating and trying to time the market. What we will consider doing is dollar cost averaging into quality names. And in the case of lithium producers, they've been quite hammered this year as lithium prices continue on the race to the bottom, as this article points out. The price of lithium was over $81,000 per ton just over a year ago, and now it's down below around a quarter of that, let's say, at $20,700 per ton. And at least one analyst over at Bank of America anticipates this glut will continue into 2025. So if you were going to invest in lithium and believe that was a viable thesis, now would be a good time to do that. And McKinsey certainly thinks that lithium has some growth in front of it. You can see here this report, they show that lithium is expected, the lithium demand by end use is expected to grow at a compound annual growth rate of 25% between 2020 and 2030. 95% of that demand is expected to come from electric vehicles. That's because lithium is needed to produce virtually all traction batteries currently used in EVs as well as consumer electronics. That means we've looked at this thesis before in a number of configurations you can see here. Perhaps most recently was this piece we wrote in October of 2020. It says, investing in lithium hasn't panned out yet. And when we first looked at lithium, this was back in 2015, we found that the three lithium mining stocks that were producing 90% of all lithium weren't seeing much contribution from lithium to their overall profits. You can see there, and this table shows in 2015 for each of the three what percentage of their profits were derived from lithium. And then look in 2016 how that jumped. For SQM, it went from 19% to almost, or say over half of their profits were coming from lithium. And when you look at the environment today, it's difficult to find up-to-date information on which companies are producing what volumes, so it's probably better to look at revenues. But this is the latest piece I could find from Bloomberg. It's a picture from 2018, and it shows forecasted capacity out to 2025, where they expect SQM to come out ahead. The five names listed here: Albemarle, SQM, Ganfeng, Livent, and Tianqi. So let's just focus on the big three. You have Livent. That was spun off from FMC a while ago. I think we did a piece on that. For 2022, they had over $800 million attributed to lithium. Then you have SQM and Albemarle, both having around a market cap of $14 billion. And SQM, around 73% of their revenues in 2022 came from lithium and derivatives, and that would have totaled $6.35 billion. So for Albemarle, in 2022, they saw revenues of $7.32 billion, and that's broken down in the table below, and you can see that lithium accounted for around $5 billion. They have catalysts and bromine. So we're going to talk about these segments here a little bit later, but when we look at Albemarle, it's really a special company because it happens to be a dividend champion. So we have a dividend growth investing strategy called Quantigence. I think it has around 80 names in it, and this happens to be one of the dividend champions that we cover. It's always exciting to find overlap between disruptive growth and dividend growth in our two strategies. For example, NextEra Energy, they're the biggest renewable energy company in the world, and they're also a dividend champion. We own it for dividend champion reasons, but we're certainly happy to enjoy that renewables exposure as well. Other names would be examples of overlap include Caterpillar, so they're a play on connected heavy equipment and autonomy. We recently did a piece on that. Then you have IBM. They're a hybrid cloud play that, of course, looks better on paper than in reality. Roper, we covered them not too long ago. They're an interesting little collection of software businesses. And, of course, we have Albemarle, the world's largest producer of lithium. I see that mentioned all over. I suppose that would be the case if you looked at revenues and market cap, depending on which day you looked. They're probably, you could say they're one of the largest producers of lithium, and they're a dividend champion. That means they've increased, not just paid, this is very important, but increased every year for 29 years in a row their dividend. Now, some assumptions here. when we consider investing in this lithium leader. The price of lithium is exceptionally volatile. We'll look at that in a second. Lithium demand can be expected to increase as lithium-ion batteries become more pervasive, but plenty of options exist out there about whether or not lithium is a compelling thesis. Now, we'll assume it is based on trends such as EVs and battery miniaturization and such, but there are also threats, so new battery technologies that use less or no lithium. And when you look at the price, this is what makes the thesis so risky from our perspective. You can see here this supercharged 2-year rally that saw prices rise by tenfold. What happens there is that everybody starts investing in projects, and then when it reverses, so the spot price slumped by 70% between November and its low point in April of this year. And of course, because this isn't traded as a normal commodity, it's difficult to get up-to-date prices on where it currently sits. But the fact is that this slump wreaks havoc on companies that are trying to sell this stuff. Here you can see SQM's latest quarter. And look on the left there, that shows revenue contribution per business line. See that big red bar dropping? That's the drop between the third quarter of last year and the third quarter of this year, the decline in the monies they received from lithium. And of course, that goes right to their gross profits. Look at the table on the right. They're showing that second red bar, which is even bigger proportionately, which is their decline in profits as a result of the, let's say, gross profits, result of the declining price of lithium. Now, I was going to mention real quickly, a lot of you have asked for merch, and we've delivered on that. So you'll see below this video some random merch pieces that we have. And also, we've made available our Quantigent's dividend growth investing strategy as well. So take a look at that. Now, let's talk about Albemarle. So they're one of the world's top producers of lithium. We love leaders. The thesis here really would be to invest in equal parts lithium growth and equal parts dividend growth. And if we held Albemarle, we'd sell. This is our rule for holding any dividend growth stock that we hold. We'd sell the moment they stopped increasing that dividend. So the dividend growth would take precedence in terms of which strategy we would allocate that to. The question we'd ask here, how likely is it the company continues increasing the dividend over time based on that? So one of the things that's quite interesting to note here is this COGS problem. So just look at how the cost of goods sold has been affected by the price of lithium. And this is rather interesting. We're going to look at the reasons they provide for that. But look at that drop in gross profit. And you can see we've shown the 9 months there highlighted for the first 9 months of this year. And there's plenty of gross profit there. But then when you just look at this last quarter, it's plummeted and just to a tiniest fraction of what it used to be. What's going on there? Well, in their quarterly earnings, they detail this in their 10Q. They talk about higher priced spodumene used during the lithium conversion process, unfavorable pricing impacts, increased utility and material costs, unfavorable currency exchange impacts. There's all these reasons that are given for this significant decline in gross margin, which is problematic, especially if you're expecting that profitability to be fueling your dividend payments and future dividend payments. Now, when we consider their 3 segments, this is important to note because one of these is significantly impacted by the price of lithium, and the largest, of course, energy storage, accounting for about 73% of last quarter's revenues. Then you have specialties. These are really lithium chemicals not connected to energy. And then this newly formed subsidiary, Ketjen, which is catalysts, hydroprocessing catalysts, really what's used in the petroleum refining industry. And they did an evaluation of this segment, and they were thinking about spinning it off, and then they decided to keep it as its own subsidiary. Now, what's interesting is when you look here and you see, well, they had gross profit of around $55 million, and then, of course, you see their other expenses, $173 million in general and administrative, so they had an operating loss of $140 million. So why do they have positive net income? Well, you can see here this line item. It's called equity in net income of unconsolidated investments. And this is a 49% equity interest they hold in Winfield Holdings, and it's referred to as Talison. And this is a joint venture they have with this large lithium deposit with another Chinese firm. And what's interesting about this is that they appear to be printing money. So you can see the net sales for 3 months of this last quarter and the net sales of the same quarter last year, and that the gross profit is almost equal to net sales. And then when they take that net income, if you multiply that by 49%, you roughly get the aforementioned $470 million that helped them achieve profitability. This JV appears to be printing money, and I took a look at the website. They have annual reports produced and audited by KPMG, but I certainly don't understand how it works. And I think a next step there for Albemarle investors or potential investors is to certainly understand that a whole lot better. Now, when you look at the performance of this stock, we don't like to look at short term, but this will give you an idea of how dramatically this stock has slid. So the 1 year return there, they've lost 58% of the share price value. And over the past 5 years, it's gained just 41%. And despite that significant drop, the yield is just 1.27%. And you can see here just this past February, they increased their quarterly dividend rate to 40 cents per share, as opposed to the previous 39.5 cents per share that was paid in 2022. So they're barely eking out a raise, just trying to keep that track record. And it's hard to understand why that is, especially when they have such a low payout ratio. So here's a look at all the materials companies that we cover in our Quantigen strategy. We're holding 2 of the top 3 names there. This is blurred out. This is available for premium subscribers or anybody who buys this report. But you can see where Albemarle sits there towards the bottom. A year's increasing dividend. They aren't rewarded too much for that. Their market cap doesn't reward them much either. Yield, of course, they're being penalized because they have such a small yield. But look at how low that payout ratio is. We will reward them for that. They have high international sales, but they're penalized for 5-year dividend growth. They're just not growing that dividend. At a 10-year level, they're not growing it very much as well. So they have a lower Q score. So our take on Albemarle would be, first of all, we don't understand their money printing JV there, which is structured as a VI structure with a Chinese firm. I think you'd really want to dig into that and better understand what's going on there. We'd like to see higher dividend increases. They certainly have the capability to do that. When you look at their investor deck, I think they mentioned that dividend track record once. It doesn't seem to be something that they spend a lot of time talking about or are heavily focused on. So as dividend growth investors, we'd like to see more of a focus on growing that. Volatile lithium prices seem to wreak havoc on gross margins. That's something that was quite a surprise. As we said, commitment to dividend doesn't seem overly vocal. If we were to invest in the world's leading producer of lithium, then dollar cost averaging into a position now really seems to make sense. When you look at the 10-year return of the QQQ, so we just measured this against the tech sector, for lack of a better benchmark, then 343% return for QQQ over the past decade. For Albemarle, just 89%. So they haven't performed very well, but this is an opportunity to add shares if that's something you're interested in. Our previous concerns around pure play certainly aren't valid anymore, with at least, let's say, around 73% of the revenues this last quarter coming from lithium at least. So some parting thoughts from McKinsey that were interesting. So new technologies can boost lithium production, and that's certainly what Albemarle is likely to be investing in. With 90% of lithium mining taking place in just 3 countries, Australia, Chile, and China, they believe that expanding it to new regions can contribute more to the resource base. And of course, they mentioned here that depending on how battery technologies develop, the industry will need more lithium carbonate or lithium hydroxide, and they'd like to see end users or OEMs signaling that to producers so they have enough time to adapt. Now, I'm going to put up another video here you might be interested in. I talked earlier about tech dividend stocks. So we did this piece here that looks at that particular topic. So certainly give that a look. Thanks for taking the time to watch this today.